Welcome, folks. This is your host, Prabal Gupta, and you are listening to The Capital Analyst. Today, our guest is Mr. Aritra Hazra. Aritra is currently the Associate Director of Strategy at ZestMoney. He has done his engineering from Jadavpur University and MBA from IIM Calcutta. After short stints as a developer and consultant, Aritra joined Samsung Ventures, where he led investments in their deep tech and service-based startups. Since 2019, he has been working at ZestMoney, mainly focusing on user growth, retention, and monetization. Tune into this conversation as we deep dive into the world of buy now, pay later and understand what are the key metrics and what are the key strategy toolkit that you need to use to build a fintech startup in this day and age. Welcome to the show, Aritra. How are you doing?
Yeah, I'm fine. Thanks. Thanks for the introduction. Thanks for the really great introduction, actually.
So let's dive right in. So let's talk about BNPL, which is mainly what ZestMoney does. So I think most of the listeners would already know what buy now, pay later consists, and I think many of them would have already used it at some point in their online transactions. But just to give a quick snapshot, I'll just summarize what exactly is a buy now, pay later scheme. So it's basically a financing scheme wherein you spread your installments over 2 to 3 months to finance any transaction. So let's say you buy an electronics for 10,000 rupees. You spread your installments in 4 parts. You pay 2,500 rupees in upfront and rest 2,500 in 3 installments every 2 weeks. So essentially, you do not get any interest cost unless you make unless you delay these payments, and you are able to spread these payments. This is essentially the crux of buy now, pay later. Obviously, there are a lot of variations on it. So with this introduction, let's start talking about BNPL. So I want to open up with a statistic that I read somewhere, and a lot of reports cover this actually. So a lot of reports mention that most of the BNPL users who make their first installment of BNPL, as I just mentioned, pay that using a debit card and have at least 1x the amount of the entire transaction amount in their accounts. So given this statistic, how is BNPL positioned in the country? Is it more of a credit provider to customers, or is it more of a liquidity management tool? How do you see that?
Yeah. So what happens is that, so in BNPL, so the definition you gave out BNPL is kind of the definition that what happens in the Western countries. Okay. If you look at Afterpay, the Klarnas of the world, it's a one. So basically, it's the buy divided into 4. Well, first part is the down payment of 25%, and the rest of pay in 3, right? And that 3 can be 2 weeks or a 1 month gap. What happens in India is because, and again, in Western countries like Klarnas and the Afterpays, the Zips of the world, basically, it's more of a shopping app. BNPL is not a financing app. Like if you look at any of the app, they position themselves as a shopping app. So it's a very different proposition in India because we are trying to build the entire BNPL structure in India. And for that, most of the brands that we have at this moment, we don't have the 25% down payment. What we have is like a buy now, pay later, pay in 3, and we spread it across 3 months. So whatever you are doing in credit card is like a 30-day period. We're doing the entire thing in a 90-day period. And again, if we look at it, this is more of a convenience for the customer. It's a payment option, right? Okay. It's like an UPI. Think of it like suppose I want to buy something like of 10,000 rupees, right? I can break it down into three parts. It's a much more easier, convenient. It's a convenient kind of a payment for a lot of these people who, and again, the main TG are the people who are 24 to 30, 32. That is the population we're trying to cater to, right? And again, if you look at the demographic dividend of India, like that a lot of people are over there who does not have access to a lot of credit cards, right? And also credit cards means a 30-day period, it's a 90-day period over here, right? Much more easier for the customer. So we are trying to position as a convenience product and a payment option. That's how BNPL in India is at this moment structured.
Okay, so given that your position, like players are positioning it as a more of a convenience option and as just another option to pay. Like if you go at the checkout page of any transaction, there's UPI, there's wallets, there's card, debit card, and you're saying that BNPL is being positioned as a 5th option that you can click so that you don't have to let go of a significant chunk of money right at the very beginning. You can spread your payments across 3 months as a more convenient option, right? Mm-hmm. So, but if I look at the competitive landscape that is emerging in BNPL in India, we see majorly 4 or 5 categories of players. One is the pure play BNPL providers like ZestMoney, which build their proposition around this. One is we see the incumbent banks also launching their own BNPL apps, HDFC Bank, ICICI Bank. A lot of banks have started offering this payment option at checkout pages. Then we have the e-commerce enablers like Amazon and Flipkart, they are also coming up with their own financing options. Then fourthly, we have something like Pine Labs or something, any other company that is trying to provide buy now, pay later. And fifth, we have credit card merchants like Slice and a lot of other fintechs that also have their own cards as well as provide you this option of BNPL. So what are your views on this competitive landscape? Is everybody positioning it the same way as a payment option? What are the kind of strategic levers they are using?
So let us consider the brands first, like the Amazons and the Flipkarts of the world, right?
Yeah.
What they are doing is basically it's a very closed loop thing, that you purchase from Flipkart and you pay using Flipkart Pay Later. The problem over here, so again, it's a very convenient thing for a customer who is purchasing from Flipkart, right? But again, if you want to have the entire if you want to have a wider selection, and that is why most of the people, like with the advent of the D2C brands, right? And a lot of people are now going away from Flipkart, Amazon to the D2C brands for a lot of these products, right? You are not having that option for those brands. And it's not just D2C, it's a lot of other things, right? You go to in-store, you don't have the option. Same for Pine Labs. You go to in-store, you have Pine Labs. You go to online, you don't have Pine Labs, right? So the main thing is, again, when I talk about convenience, the convenience is not just about the payment, it's the wider selection. And that is why the other players like ZestMoney, the Slices of the world, they are having an edge. Because it's a one-time solution for all the players. It's not just specific to, I'm not purchasing something just from Amazon or Flipkart. It's, again, I have a lot of other brands that in-store, online, a lot of things. So the convenience, if I have to think about convenience, it's very simple for a customer. It's very easy for a customer to understand that this Slices and the ZestMoney of the world will be much more easier. Because again, the proposition is the same, right? The 3 months 0% that we are doing. And again, Flipkart is doing the same thing. Like credit cards are doing 1 month 0%, not 3 months 0% again. So if I consider the payment option and also the wider selection, it's much more easier and much more convenient for someone to have a system in a slice of the world. What I feel, the difference between what this BNPL providers are doing as opposed to a credit card, because it's a 30-day period, right? Again, the point is that what we have to understand is that a lot of these credit cards are not given to customers. Let us think of, again, it's not a it's not a competition. Sometimes what happens, we have a lot of customers, not just this money. A lot of these BNPLs have customers who have multiple credit cards, right? But it's basically that if you have an option, if you can split your entire expenses into 3 months or 1 month and pay later, then, and again, if you look at look at the expense of someone. And again, given the income segment we cater to, the credit card limit is not that. This is a common psychology that I don't want to spend 100% of my limit. It's some X percentage, varies from person to person. It varies from 30 to 60%. Like I don't want to exhaust more than that. So if I have multiple, so if my limit is 30,000, then sweet spot is 30 to 40% of my limit I can spend, and that's around 10 to 12,000, right? And if my expense is 30,000, 40,000 in a month, then basically it's easier for me to split across different cards, cards or the BNPL providers. And so that is the reason that the BNPL players at this moment, the ZestMoney, the Slices, Symbols of the world, that is how they are thriving, because it's not a competition of credit cards on one hand, and for a lot of people, it's much more convenient than a credit card. And again, for the other, like the closed loop products, like the Flipkart, the Pine Labs, and the Amazon, it's much more convenient with a wider selection. You have the option. That is the reason that we don't see ZestMoney as it's a very big competition with the credit cards. It's like a complementary product with credit cards with more added advantage.
Okay.
For the younger users.
Makes sense. So if I talk about the financing part, like it is easier to understand the credit card business model because banks have a lot of low cost deposits that they can use channelize to lend money on their credit cards. And whenever a customer misses payments or is overdue, they charge hefty interest rates. And that is how essentially they are making money from this credit cards. Plus there's the second option of merchant discount rate, wherein they charge the merchants for enabling those credit card transactions, because generally it is observed that credit cards act as a tool to increase purchases and transactions in stores. When I draw a similar corollary to the BNPL ecosystem, I want to split it into two parts. First, since how much traction are we seeing in merchants adopting BNPL system? How useful are they finding it to promote their sales, to build better customer relationships? Because at the end of the day, the value proposition for the customer is fine, that it spreads your payment across 3 months. It's a financing tool. It's more convenient. But for the merchant to enable this payment and to pay some percentage as a cost, what are the kind of metrics or what are the kind of traction that BNPL gives, which provides them with an edge over other financing schemes like EMI or let's say credit cards? And second of all is how are companies thinking of financing the cost of lending out through BNPL? Recently, we have seen that a lot of players, even ZestMoney has acquired an NBFC license through their subsidiaries to start giving loans basically on their balance sheet. So how do you see this going forward?
So let me first talk about the merchant part, right? Okay. Why and how, what do you see from the merchant side, right?
Sure.
So now that we are seeing a lot of these customers, like the young TGs, who like they shift a lot to the BNPL players, even though they have credit cards. It makes a very logical sense for basically the merchants to adopt BNPL. And again, we have seen this a lot that the merchants reach out to us. We don't have to reach out to the merchant. Initially, we had to reach out to the merchants. So basically, now the merchants reach out to us, and again, the point is that now what they are doing is that they are submitting the loan also. Like the 3 months 0% that we are taking, one thing is the MDR, the merchant discount rate. And I can talk about the economics later. But again, so they are giving it to us because we are enabling the payment. Let's talk about a 6,000 rupees, 7,000 rupees. That is a sweet spot of a D2C. A lot of the D2C electronic products, right? It's much easier for someone whose income is around 35,000 to spread across 3 months or to spread across 2 months, or right. So basically, you have different options, right? So it's natural for that player to have the different BNPL players in checkout, and we have seen that traction, a lot of traction from the merchants. What is happening is more interesting is that the merchants are submitting the 3-month loan for us. That means that the 0% that we are giving to the customer is basically like if you take any interest rate, right? So basically, let us take a hypothetical interest rate of 1.51%, declining. That is around like a 0.7, 0.8%, right? The 2% across 3 months, right? The merchants are submitting us, so they are paying us the money to submit. So basically, that is again not coming from our books. If you look at the cost of funds that we have to pay to the NBFCs, right? And if that is, let's say, 1.5% across 3 months. I'm just taking hypothetical numbers, right?
Yeah.
Because the interest is obviously higher than the cost of funds. Initially, we had to pay the cost of be at that 3 month 0%. Now they are submitting us, and again we have seen the bigger merchants. Like I am not taking the name, but again the very big merchants, be it OEMs and be it again the marketplaces, horizontal marketplaces, right? They all are going to the system. And they are submitting because they are seeing that 3 things actually. More number of customers are coming. The repeat rate in that merchant is increasing because of this flexibility, that the option flexibility. Now they can spread across different players, right? If I were buying around 10 to 15,000, I would have spread across my credit card. But since the credit card, like the 40%, 30%, 60% number, like if that is spread across like I don't want to spend more than 40, 50% of my credit limit. If that is across 3 different limits, the customer can pay back. That is there. But again, they want the flexibility of 3 months. And we have seen that the repeat rate for that merchant from one customer cohort is increasing. And we are also seeing the AOV increasing for the same customer. So these 3 things to combine together makes it much more easier, much more logical for that brand to submit the 3 month 0%. We have seen this around, like not just ZestMoney, across the industry, that when we don't have 3 month 0% and when we have 3 month 0%, the volume, the uptakes are much higher. And again, if they submit, that also it makes much more economical sense for the mathematical sense for them.
Got it.
So this is how, like I'm pretty sure we will be discussing that also. We can cover that later. The MDR and subvention is covering up for that entire cost of fund, and that is how, even though we are seeing a CAC, that we are making money even from the first transaction. If I discount this.
Okay, so now that you have brought out different business models into picture and why BNPL has an edge over other tools. And basically you mentioned 3 points, which is essentially the key output that you expect from any marketing tool. A is either it increases customers, or it increases repeat purchases, or it increases the average order value, or in this case, the average transaction value. And you're saying that BNPL is something that has enabled these for merchants, and that is why they are willing to subvent. When you talk about the subvention, what exactly does this entail? What does subvention mean, like for people who are new to this term, and how does that work out, and how is it different from something that used to happen earlier with credit cards?
Let's take a scenario when, let's take a merchant A. We are sending and the customer goes to merchant, finds any BNPL player in the checkout, and then signs up and gets the limit and transacts using that. Then there are 2 things that happen. One is that we are like the brand merchant, they pay a certain amount, be it 1%, 1.5%, that is decided to the BNPL player, because the transaction has been done through the player.
Okay.
That is the common term called merchant discount rate. That happens with credit cards also, right? Now there's another term called subvention. I'll just explain that. What happens is the BNPL players, they give 3 months 0%. Again, that is the common term in India. And again, for a BNPL player, it's a platform basically. They take the funds from a lender, be that NBFC or a bank, and they act as a platform in which they are supplying the money to the customer, to the merchants, to the customer, right? So the NBFCs, they charge some fees for that, right? Now, typically, the MDR the merchant discount rate that the merchant is paying me should ideally be equal to the cost of funds. But again, for a very new player, because that is how this banking works, right? Till the point I have got the numbers, the cost of funds will be higher, and then with time it goes down, right? So initially the MDR is not equal to, or it's lesser than the cost of fund that the platform has to pay. The platform means the BNPL player. What we have seen is that now, because the BNPL players are actually enabling transaction for the merchants, they can now go to the merchants and then negotiate that this 3 month 0%, you pay me that interest rate upfront. So basically, from the BNPL players point of view, that is again the money that they are getting not from the customer but from the merchant. So passing the cost of the funding to the merchants, not the customer. And the merchants, we are seeing with time, more number of merchants are adopting to this, and it's not a conversation that we are saying. It's a unsaid rule that the merchants know at this point that they will be providing a subvention and also the merchant discount rate whenever we are having a conversation that let's have a partnership. Okay. And that is the common scenario that has happened at this moment.
So just to see that if I've got this correctly, so there's a merchant discount rate wherein you're saying that the merchant is giving up some certain percentage of the total amount for availing the services of the BNPL platform, because they are essentially bringing that customer to their store and increasing transactions at his end. And second, since BNPLs don't have funds of their own as of now, they either have to raise money from NBFCs, get an NBFC license, or get some other source of funds. Merchants are also subventing this by providing these funds to the BNPL player, which essentially gets routed back to the merchant in a way.
So let me just explain a simpler term. So the merchant discount rate, let us think of merchant discount rate as something that the merchants are giving me for making the customer, for bringing the customer to the merchant.
Okay.
The 3 month and the subvention is basically how to make more number of customers, so the same customer repeat more and more, because we have seen that when there is a 3 month 0% as compared to a 3 month interest rate, or again a 1 month rate, the same customer is making more number of transactions at a higher increased order value, right? So if I now divide these two terms, right? Bringing a customer, the merchant is giving me a merchant discount rate, a 2%, 1%, whatever, right? For making the customer transact more and more, increased repeat, increased frequency, the higher AOV, they are paying me something else. So the first thing is the merchant discount rate, the second thing is the subvention. That is how we normally say this. And these two,
So subvention essentially means that there's an opportunity cost for the merchant because he's providing the funds. He's not getting the entire amount upfront. He is waiting those 3 months to get the entire money back.
So basically the merchants are giving that fee upfront to me, which is basically covering the cost of funds that I am.
Okay. So you're saying that you are giving the entire amount after subtracting merchant discount rate to the merchant, and they are paying you basically whatever your cost of funds is, or whatever your negotiated number is, as a subvention fee, so that you can cover your financing.
Exactly.
So got it. And the entire financing risk. So there's a financing risk in the firm that the customer can default on these payments, or pay later, or maybe pay some amount of the transaction. And since there's no collateral as such, and so who bears the financing risk in this transaction? Let's say the current example that we have been talking about, where the merchant is subventing as well as providing the MDR, and the BNPL is raising funds externally from some source. The entire financing risk is borne by BNPL. What are the kind of arrangements you have seen in the industry? How do these things work?
So this BNPL players, they have a lot of lenders at their back, right? So it can happen like a Bajaj who has the NBFC of their own, or the new age players like ZestMoney, Slice, Unicard, so they have BNPL NBFC players lenders at their back. Now the arrangement is such that at the very starting, when you are new to the business, basically, then it's a complete risk. It's not a risk sharing model. The BNPL players have to take the entire risk. But again, when you are into the business and you have shown the numbers to the lenders, then you can have an arrangement that it's a risk sharing model. And again, that is this is a business also. Like for example, we know that there are some businesses which the risk is much lesser than the others. It can happen, right? You have different business lines. For them, you go into arrangement with the lender that the lender will say that let us do one thing. Let's have 50-50 risk sharing model for this kind of, and I will promote more of this kind of business to you. So what happens is, like for example, we have Amazon, in which we are enabling transaction Amazon, or let's say horizontal marketplaces. With another, let us say education, like for example upskilling or the K-12, right? Maybe so there might be two lenders. One will say that I will promote, I will give you funds for Amazon, the horizontal marketplaces. I will not have a risk sharing model. You have to have the entire risk, but again for that I'll be taking a lesser interest.
Okay.
But for the education, they will be saying that we have seen your portfolio and we believe that like we can take a risk sharing model. And again, I'll be promoting just that line of business for you. So that is how it is structured at this moment. The bigger the business is and the better the numbers are. The numbers are basically the LTV to CAC, right? Again, at the end of the day, for an older cohort, and how these numbers like mature over time, then that gives us more confidence to go to the lenders and say that let us have a risk sharing model for all the kinds of business. But again, it takes time. Basis the risk numbers and the profit numbers.
Got it. LTV. So just to wrap this section up, another term that came up in my research was FLDG, or first loss default guarantee. And so even the RBI has been in talks recently to come up with some rules regarding how much financing banks can provide to BNPLs and how this FLDG structure looks. So if you can shed some light on what is FLDG and what's its impact on the industry right now.
So I'll just explain very short. Like, so what FLDG means is basically for the lenders with whom we don't have a risk sharing model, like the entire risk on ZestMoney books, basically, they need a guarantee that you have to have this X amount, X dollars or X percentage of your total balance in your books, like that you cannot lend basically. Because
as a capital buffer,
as a capital basically.
Yeah.
So it's a first default guarantee basically. So basically the X percentage, and that is again that again varies from like the same, right? So that varies from the players to players, with lenders to lenders, right? For some lenders it might be 5%, for some lenders it might be 8%, 10%, depends on how they are figured.
Okay, so that is the money that the lender is kind of making you keep with you as a reserve in case things go wrong. Okay.
Exactly.
Okay, got it.
Cash reserve basically. Cash reserve.
Yeah. Makes sense. Something that banks themselves keep as a capital adequacy ratio in very safe assets.
Exactly the same, but the percentage is much lesser than the banks. Because the RBI guideline is around 20-22%, I think.
Okay.
And that is much lesser for us basically. But again, when you have an NBFC license, when you are lending entirely from your own book, then it will be higher.
Okay. Got it. What we have seen is, so around 5-10 years ago, there was a trend of unbundling, wherein financial services were being unbundled and specialized players were entering the market that were catering to each specific niche. So they were insurtech players who were offering insurance. There were wealth management players. There were payments apps that were just managing your payments, and so on and so forth. And right now, what we have observed is there's a trend of rebundling, or everything coming together into one app. That one app that can cater to all your financial needs. Let's say, which essentially becoming a super app. And as you have mentioned at the start of the podcast, that a lot of the players in US, especially BNPL players, see themselves more as a shopping app. That we are not just a payment mechanism. If you need something, if you want to buy something, you better go on an Afterpay or Klarna instead of going directly to the merchant website or something like that. So how do you see this trend playing out in the Indian ecosystem? Do you think it's somewhere down the line we are trying to reach that, or that is not the priority right now?
What I feel is that like this BNPL market at this moment is still quite nascent. And for that entire super app, the bundling to happen over here, there needs to be a lot of consolidation. That is again my own personal view, right? And because at this moment, what we are seeing is almost equal players in the market, and they're competing with the bigger players like the credit cards and the Bajaj of the world. It's very difficult, I'll say, to have a very sustained profitable model. And again, it's this, and again, so basically, a rebundling happens when you have complete hold on your main line of business, and you are 100% sure are profitable at a sustained basis. You can keep that up. As my personal opinion, is not the case at this moment in India, and that is the reason that also in India the Klarna. So if we look at Afterpay, they focus a lot on experience. Everything around them is experience, right? If I don't want to go to Amazon and I am going to Afterpay to buy something, it's a very different very different mentality change, which is we are a bit far away from that at this moment, because experience is something, and the entire customer experience to be at the best is something which you can look at and focus on completely. When your entire business at this moment is, you have a complete hold on the path to profitability, and also you are profitable at this moment. That is when you focus more on the experience and rebuilding part. It's my personal opinion.
Got it. So in your opinion, you feel like when a business has built a strong enough competitive advantage, or let's say moat, as we say in investing terms, around its own main line of business, so that it knows that it can loop in other services and customers won't just abandon it, or customers are habituated to use that product, and you have those internal cash generation to fund those expansion activities, then it makes more sense to take that leap.
Yeah, so basically, like for example, let's think of this, right? Okay, so I know that at this moment, if I am a customer, if I want to buy insurance, I go to digital app. If I have to get BNPL or EMI solutions, I go to ZestMoney. Example. And again, if I want to go to something else, then I go to like a different brand. Right? It's a fragmented market, right? So basically, the brand has to be built that if I have to buy one thing, all the things together, there has to be a single app, which is not the case at this moment, because again, that branding is not there at this moment. And for that branding to happen, you have to be this requires a bit more time actually in India. That is what I'm saying. Like, right? So yeah, so everything is a bit fragmented.
Essentially, you are saying that it's very early days for the BNPL ecosystem in India. People are still getting used to this concept, adopting it, and it will take time to gain a sense of the market and gain a stronghold, and then you can launch into other value-added services along with BNPL.
Yeah. So okay, I'll just take a second for this. So what normally happens is people equate this BNPL with a loan, but so it's not. So when I'm paying in a Swiggy, it's not a loan. This mentality is very different. It's a very early days, because when people equate this as a loan, then the entire thing changes. Like I don't want to buy something on a loan. Well, it's not a loan; it's a payment option. So once we have that, like when people have that complete understanding, underlying assumption changes, then they will look at BNPL in a much different way, which is again happening, but it will take some time. Like 3 years back, like it was a loan. Now a lot of people are adopting this, right? It was so it will happen. It will take some time, as per my understanding.
Another question before we move on to the next section of LTV and CAC that came to my mind is that so even if we go back 5 years, even if at this point in time today, Bajaj Finance was is one of the biggest leaders in this space. And especially if you are buying slightly higher ticket purchases like electronics or kitchen appliances or gadgets, you'll always see Bajaj employees in their stores, and they're offering you zero cost EMI and financing and all these kind of schemes, not under the name of BNPL, but a similar use case. And maybe they are not positioning this as a payment option. They are positioning it more as a financing tool or as a loan. But they have a very significant market share. Some reports even mention upwards of 75% in consumer durables. And they are extremely profitable if you look at their financials, share price performance, all these things. So do BNPL players feel this as a potential competitor, or do you think they have a different niche, or how do they approach this confrontation with such a big player already existing in the market?
Completely agree, right? So basically, Bajaj is like the behemoth in the market, and again, the BNPL players are nothing as compared to them, right? But again, the competitive advantage that the BNPL players have is that it's completely digital and it's much more easier than again an entire offline scenario, right? Like filling the form, right, and going to a store and stuff, right? Again, so going to a store, Bajaj is the default option for a lot of people, right? Because they have the trust, and again, when it comes to money, trust is the most important thing. As simple as that. You don't care about convenience as much as the trust. When I'm talking about 1 lakh electric vehicle, if you have to buy a electric vehicle, EV for like 3 lakhs, right? That will always be there. That is very difficult to that is very difficult to dismantle actually. So we are not even competing with them. Like none of the BNPL players are again competing with Bajaj. It's more of a very different value prop they are bringing. And again, if the customers value that proposition more than what they are seeing, then they will just choose a BNPL. It's mostly online. It's much more easy. It's a 1 minute process. You get a limit. You just pay everywhere. You pay not in the offline stores, you pay in a Swiggy also. You pay for a 500 rupees Myntra also, right? So that is the value prop. The overall entire selection You have a Bajaj. It's completely okay. We are not even there. None of the players give a 5 lakh rupees ka loan. Bajaj gives that, right? So this is completely okay. But again, for 5,000 rupees, if you think that for a 5,000 rupees convenience is more important to me than the trust maybe, then they go to a BNPL.
Got it. And I think that the demographic that you mentioned about 24 to 32 or even lower than that are essentially people who are entering the workforce who are new to credit, new to banking, as they say NTB and NTC customers. And it's easier to build trust with them because they have been using digital payment apps, they have been using the e-commerce websites and all that. And their ticket size would not be as high right away. And they would have a lot of transactions in their life that a big player like Bajaj might not be interested to even finance. So
exactly.
Yeah, so that's the inroad that BNPL players are focusing on. That makes sense. Okay, now moving on to the second part. So we have talked about how BNPL is enabling increased customers, repeat purchases, and increased AOV for merchants. But at the same time, to do that, BNPL also has to do all these three things for itself as a platform as well. So I need to onboard more customers. I need to convince customers to spend more through the BNPL payment option. I need to ensure that they are comfortable moving on to higher ticket sizes using that BNPL platform. So herein, this is basically, I think, most of the work that you do in your current job as associate director of strategy. So one of the key metrics that we look at when evaluating any decision, as you have already mentioned multiple times in the podcast, is LTV by CAC. And there's something that I think nobody knew 5 years before. It was not as popular as it has become right now. But very few people understand what is exactly the key drivers of LTV by CAC. And if I look at an LTV by CAC chart or number, what kind of insights I can draw from it. So if you can just break down what is LTV, what is CAC, and creating a number LTV by CAC, how do I interpret that in a more broad fashion?
So even LTV by CAC is again like even 3 years back when I joined, that was a key metric that I was told to drive. I did not know that. Again, it's very difficult for a lot of people to know this. So LTV is basically the lifetime value, and by lifetime value is we can look at lifetime value in a lot of different ways. How we look at lifetime value is the lifetime profit of a customer, right? So, and again, lifetime value. How will again for a customer we can have a lifetime value, and again because it's a lifetime value, we have different time periods. Like for example, what is the LTV in 2 years? What is the LTV in 3 years? Right? CAC is a one-time thing. When the customer has been acquired, he or she has been acquired. The CAC is constant. Right? So now what we can do is basically increase the profit of a customer. So basically, if I look at LTV by CAC, what is the time duration you are taking? 2 ways. What is the time duration you are taking to break even, basically?
Okay.
Right? And then how you are making profit to other. In a 2 year period or X month period, how much profit are you making from the customer?
So to simplify what you have said, Abhitak, when you're saying like first we are trying to say like what is the break-even level when that customer break-evens for the company. So essentially when LTV by CAC is very close to 1, for what time period LTV by CAC reaches 1, that means that I have recovered the money that I spent on acquiring that customer through discounts, marketing, and etc. And then you see that going forward, what is the earning potential, earnings that this customer can give me for the next 1 year, 2 year, 3 years, whatever time period you choose.
Exactly, like you said, that is how we define lifetime value of a customer. Like in a 1 year period, 2 year period, 3 year period, and that varies from company to company how they want to look at this, right? Now that is lifetime value, and again, if I want to break it down in terms of like in a BNPL player, right? Let me come to CAC later. So lifetime value is basically the interest you are getting out of the customer, the money you are generating minus the amount that you have to give to the lender. That is the revenue that we say, right? Then minus OPEX. We have a lot of OPEX, like some OPEX, like for example, we pull there's a lot of cost for KYC, right? Okay. There's a mandate cost, right? So those are the things that happen. Collection agencies cost. So that is the OPEX part. And then comes the risk part. Risk is basically how many customers are defaulting and what is the percentage amount that is defaulted. That for any cohort, that will give the that will the value as in the profit unit economics level profit of a customer. And that again across times increases because the major factor that is driving the LTV is the number of repeats the customer is making. Because what happens is when you in any lending model, you are underwriting, you have a lot of rules in which how you are underwriting the customer, right? the first time when you're underwriting the customer, that is prone to a lot of errors. And again, what happens is it's not possible to underwrite 100% perfect way, right? And that is the reason we see that the risk of the customer for the first transaction is higher. But again, the risk decreases drastically in the second, third, fourth transaction, because again, you are the customer repeat. That is the reason you are like increasing their credit limit and they are repeating again and again, right? So a major factor that is a part of the cost is the risk. And if that goes away, then the customer also, what happens is that we have a lot of different products. We have installments, in which is a 6-month product, but it has interest. We have personal loan, which is again a 12-month or 24-month product, which again has interest. Right? Then it's easier for the customer to, and again, that is a higher ticket size. So when I look at any financial institution as a customer, I will, if I need something, I'll first take a smaller ticket item to understand whether that I can trust this or not. When I have a proper trust on this, and I understand that, yeah, the late payments, like there's a complete transparency also is much more, like this entire product experience is really good, then I make that as my default payment option as compared to a side payment option, right? And then you go and transact all the things from that player, and that is why you make that is why you graduate from a Myntra to a electric vehicle, EV, right? Through the same. So basically, that is how the LTV is ultimately built, and again, you are getting interest from the customer basically for that. So the major drivers for LTV are the number of repeats the customer is making, and again, the risk again as a function of this goes down more and more. And that is the reason that in X number of months, or the other way to look at it, after how many transactions is the customer profitable for you, or the LTV to CAC is whatever X that you are trying to achieve, be 2, 3, 4, 5.
Got it. So just a technical question to clear my doubt. So this LTV by CAC, like what unit is it defined for? So is it defined for a particular customer? Let's say I am a customer of a BNPL platform, and let's say that Prabal has this, has transacted this much. Based on this, we can estimate that this is the number of transactions, number of repeats, and average transaction value that he'll do in the coming years. And this is how much is our estimate cost of we spent on acquiring him, maybe some discount we gave him or anything else. And you calculate this for me, or you calculate this for all the people in that year who joined that platform as a cohort, or do you calculate it on the basis of product categories that for 3 months 0%, this is the LTV by CAC, for 6-month loan, this is the LTV by CAC. So how is this defined?
To understand basically the business, we have to look at overall. So there are two things, right? One is to understand how we are doing, right? And for that, we look at overall LTV to CAC across different cuts, like you mentioned, right? Like what are the different cuts in which we can look at, so that we understand why the business is going on, and basis that we take decisions, right? Like for example, you mentioned it, 310%. What is the for high velocity? That is what you call high velocity. High velocity, what is LTV to CAC for a customer who has been acquired? By customer, I mean a cohort of customers who has been acquired 2 years back. And how is that path, right? What is the path for that customer cohort? From that, you understand what should be the path for the entire company to be profitable. We have different cuts. Like for example, like high velocity, 2 years mein the LTV to CAC is, let's say, X. For installment, for customers who are acquired for a 6-month product who are interest bearing, for them in a 2-year period. And again, we take different. When I say cohort, we take at least 4 to 5 different cohorts to understand whether this is stabilizing or not. This actually holds true or not. And then we see that this LTV to CAC is Y. Then again, by that logic, we then take a decision basically how to, like, what should be the path. An example is normally for traditional business, like 5 years back, or 3 years back, how it used to happen is that the business used to spend a lot of money on Facebook, Google, most of the performance marketing to acquire customers, right? And again, the cost of acquiring a customer on Facebook, Google for any kind of business, the CAC is really. So to make the customer profitable, they have to make much higher, like a lot of repeat transactions, right? So what we have seen is that, like now that we are live on merchants also, and merchants are like actively promoting us, we are actually getting customers from there, and the CAC goes down to zero. It's a zero CAC, right? So basically, it's much easier for us to make that customer profitable, because even if the customer makes much lesser number of repeats, then also the customer becomes profitable, right? But again, the point is, even if a customer has been acquired with a let's say higher CAC, that customer, because after 3 to 4 repeat transactions, it's much more easier for me to make the customer repeat again and again and again. So in a long term, that customer is way profitable than a customer who is making 3 to 4, but giving me profit in the very first in the very first transaction, because that is not the natural. When I'm getting the customer from a merchant, right, that customer is not that loyal to me. That customer only remembers me when they are thinking of that merchant or that category. But when customer is coming, looking at Facebook and then coming organically, basically. So how it happens in performance marketing is, I see an ad, I click on that, I see an ad, I search on ZestMoney, and then in Google, and then I come back. So basically, those customers you have seen are much more loyal in terms of repeat than customers who are coming through organic means. And
okay,
right.
So essentially, what you're saying is that the way you acquired those customers in the first place is also a very important metric to judge their LTV by CACs. Right? So LTV by CACs can vary significantly for different types of customers, different types in the sense how did they end up on ZestMoney, and the strategic alternatives that you need to take can vary because their loyalty levels, repeat purchases, average order values will be significantly different depending upon how they communicate with the platform, how much do they spend, and who was it in the first place that prompted them to go to ZestMoney. So that's also a metric that you are saying is important.
That is a very important metric actually, because from where the customer is acquired is one of the, and that helps us understand why we have to invest money. As in, suppose your marketing budget is constant, right? So do you invest more in the paid marketing, or do you have more strategic partnerships? Because again, that is also a cost, right? That is also a cost in which sharing model, like a discount sharing model with them, 50%, 20% discount.
So you're saying that it's a simultaneous decision. So at the one hand, you do some marketing activities, you understand what kind of CAC you are incurring for what kind of customers. On the basis of that, you see that what is the LTV that they're generating and whether this customer can become profitable. And if not, if there is something that we can do to make that customer profitable. And depending on that, you again reevaluate your marketing spends to see how much is the bandwidth that we can spend without impacting profitability.
Exactly.
It's a continuous circle decision, like CAC driving LTV and LTV influencing what should be the CAC and something like that.
Yeah. LTV influencing what should be the way, like again, give me marketing budget constant, what should be from where, what are the different areas from where we should.
LTV tells that how much can I afford to spend on this particular category of customers. Like
going forward, yes.
You won't, like if you say that customers acquired from merchants are not that loyal and maybe their frequency of repeat purchases are not that high, then you would say that to the marketing team that, hey, don't spend a lot on promoting our product in this category. There's a certain budget that we can afford, but not beyond that, because these customers don't have that high an LTV.
Yeah, exactly. So that is how LTV is calculated. But again, there are a lot of other smaller factors. So basically, these are the customers who are acquired from merchants. They are the customers who typically we have seen, and that's true for any BNPL business, they are not the ones who are paying us, who will be taking an interest-bearing loan. They're taking a 3-month loan. The repeats will be high, but again, they're not making money for me. The money I'm getting from MDR and Subvention is not as much as the money I'm getting from the interest from the customers. That is again, it's never that much, right? Also, they are not the ones who take a personal loan from. Higher ticket item, that is what Bajaj is really good at, is what gives you money. The smaller ticket items are basically the transactors in a credit card, right? I think, right? So they don't give you money, but what they do is they reduce the overall portfolio risk, which helps you take more higher bets on those customers. So the risk goes up, but again, the interest rate also goes up.
So you're saying that because it's low ticket size, high turnover, the risk essentially reduces because these are small payments and they are happening very frequently. So you're better able to judge whether to keep extending the BNPL services to this customer or not. And even if you lose very small amounts, because let's say if you 500 rupees on Swiggy, 1,000 rupees on Amazon or Myntra or something like that, it gets recovered quickly and you get a better sense. Well, your data pool becomes stronger on that customer, that we can keep lending to this customer because he has or she has been paying frequently.
That not just that actually. So basically, we have seen that there are, like if a customer is taking 2,000 rupees or 2.5K paying 3 or 5,000 rupees paying 3, and also depending on the merchants, right? This like we have seen there are certain merchants in which, or certain category of merchants in which the risk is way lower than like certain other category of merchants. And typically, this 3,000, 3,500 rupees is not prone to a lot of defaults. Because these are the customers who are actually good. Like again, by good I mean that they are the customers who can pay back and who can pay back, and they are spending from what they are financially aware. It's not a desperate thing for them, and they are and again so this is the reason that these customers are much lesser prone to defaulting. Like a customer is transacting a D2C merchant as opposed to a customer who is getting an Amazon voucher. Is much lesser risky. It's much, and that is across the industry actually, right? So these customers reduce the risk a lot for me.
Okay. So essentially, if I have to sum it up, so you're saying that at a broad level, this gives me LTV by CAC gives me insights on customers as a whole, as a bunch, as a cohort, and you can just keep on adding layers of granularity as the data shows you, and keep on generating insights that what is the best course of action for us as a platform to provide additional services to this customer, how to market it. It's essentially like more data points you look at, more granular your insights would become, and you can have more individual level targeting for that customer or cohort.
Exactly. And one of the major problems with LTV by CAC is that it takes some time to mature.
Yeah, exactly.
Right? So that is because you cannot take decision on a monthly basis.
You will need some data to gather insights from it, and that data you'll have to eventually go to the market and test it out.
How it normally happens is, let us take a cohort of 2019. In 2022, they have matured 3 years. But again, right? But for 2021 cohort, it has matured only 1 year, right? So what we see is the vintage till that point in time. We call that a year on book or month on book. So in 1 year, let's say for 2019 cohort, in 3 years, the LTV to CAC was, let's say, X plus 0.5, X plus 0.7. Now we see Y for 2021 cohort, for a 1 year period, we see the LTV to CAC in 1 year is Y. We just compare Y with X. Typically, Y should be greater than X.
Okay.
For a business to be successful.
So basically, the 1 year performance of each cohort you are comparing to see how our business is growing.
Exactly. And
you are looking at the long-term trend to see when this growth curve plateaus, in the sense that it matures, so that I can build this into my forecast. That what is the maturity point wherein like the customer has stabilized, that this is the number of transactions, number of repeats that it is going to do for the coming years. There would not be much more volatility in this, because that's your average expenditure for a month.
Exactly. Yeah. So basically, after a certain, we have not yet seen that plateau.
Exactly, because that will also take time. Like once you see it, then only we'll be able to say that this is a plateau, because you can't predict.
Yeah, exactly.
Another thing that came up in while I was reading more about this industry was the concept of product funneling. I mean, I have no clue what a product funnel is, and especially in context of a BNPL. So if you can just share some insights on what it is, how it is important from a strategic point of view.
Now, so LTV to CAC, let me discuss about LTV, right? So basically, let us come to CAC. What CAC means is again, cost of acquiring a customer. So how it happens is, we acquire a customer, like let us say that a customer sees ZestMoney, then signs up. That is the top of the funnel. Again, a top of the funnel can be a lot of different things for different businesses. Let us, for this example, say that when a customer signed up, that is when the customer has the first touch point with ZestMoney. Now for that, but that is, he or she is not a customer of ZestMoney at this till the point they have transacted or they have got a limit. You can define however you want to define when you have acquired the customer properly, but it's not a sign up. So the entire journey from sign up to the point where you are actually acquiring a customer, depending on that business, is the entire funnel, product funnel. There will be different steps to the funnel. Like for example, let us take a very simple example. So a customer signs up, they have to fill a personal details, like for example, the name, address, email address. Okay. Then a customer, 100 customers sign up, 20 customers drop up from that page. Then the conversion for that particular page, again, I'm just calling it a page, or we call it a step basically, is 80%. Then till the point the customer actually makes that first, like however you want to define the acquisition, the activation or transaction, there are some customers who have dropped off again. So that the entire thing makes, like other customers who have dropped off and you have paid money to acquire that customer. So you pay 1,000 rupees to sign up 100 customers, but again only 50 customers transact. So basically your cost of acquisition becomes 1,000 by 50.
Got it.
Right. So one of the major things for CAC is to understand the entire product funnel and how to optimize it the best, how to make it the most lazy.
Okay. So you're saying that the essential motive is that there is no drop off along the journey. So like the number of customers that I'm targeting and the number of customers that end up using BNPL that I'm providing for a transaction, there should be very minimal difference, like as close to 100% as it can be. And product funnel helps me trying to increase that number to close to 100%. So there is very low gap in the number of customers that I targeted and number of customers that actually became my transactors.
Yeah, the product funnel is basically an indication of how your customers are viewing your value prop as opposed to the effort that they have to give to go to that value.
It's more of a logistics thing. The fact that the person signed up shows that he was interested in getting into BNPL or exploring a BNPL payments option, but the fact that he didn't finally transact on the platform means that something wrong happened in that journey, and product funnel helps to find that and maybe correct that.
Okay. So not exactly.
Okay.
So product funnel, you whatever you said is completely right. But product funnel is just the indication that whether that customer, how many customers have dropped off, and again that means that basically this 20 out of 100 customers who signed up, let's say 80 customers made the transaction. These 20 customers did not feel it. The effort is as opposed to the value that they are getting is that much. So that is the reason that. So it's basically an indication.
Okay. So I got it. But what are the strategic implications of this indication? In what context will I use this indication while making a business decision?
Oh, there are a lot of things actually. So basically, your entire performance marketing budget, if you have a performance marketing budget, is completely a function of how good your product funnel is. Like if I see that my 100 out of 100 customers were signing up, 20 customers are transacting, as opposed to a business in which 100 customers are signing up and say 80 customers are transacting, the budget will be very different for the same line of business. Like for example, if I have to give a 5 lakh rupees, if I have to give a loan, I'm calling a loan for a 5 lakh rupees, the way I'm underwriting will be much stricter, and the things I require from the customer will be much higher, much more, as opposed to when I'm given 10,000 rupees ka limit, right? So basically the performance marketing spends should also depend a lot on that. Okay,
got it. So it's a tool for evaluating my marketing strategic action in a way that the marketing actions or marketing plans with the highest product funnel rates or highest conversion rates, so as to say, working well for us, and we'll try to promote them over others where the product funnel is showing a lower number in a way.
Yeah. So the example that I give, it's not really relevant to that because I am just thinking about this because the 5 lakh product is very different from 5,000 rupees product. But again, let's say you have in mind that for LTV to CAC again to become positive, if the CAC has to be some X, for that CAC to be, let's say 100 rupees, your product funnel from end to end should be 20%. If you cannot reach 20%, if you're at 10% at this moment, then you are never profitable because again, the amount you are spending in Amazon, in the performance marketing has remained the same because again, you have only a couple of options, not 4 to 5 options. If you are not going to a different strategy of acquiring customers from organically, for example, for the merchants, let us leave that out for that moment. Then you know that even though I am acquiring a lot of customers, but the number of customers coming to the end of the funnel is not increasing on the it's not increasing that much. So till the point I have a really good product funnel, I cannot really promote that. Yeah. So one more reason is that again, this is something that happens with performance marketing. Once you spend more in performance marketing, suppose you are spending 100 rupees in Facebook, Amazon, in Facebook, Google. You acquire, let's say 10 customers. If you spend more, you acquire less number of customers. The economics of scale is not it does not operate on economics of scale.
Decreasing returns of scale, basically.
Exactly. So more you spend, the number of customers decrease, and again there is a point where it never makes sense. So for that, the more you spend, the better your product funnel should be.
Okay. So it helps to identify the saturation point of that performance marketing plan, that since they are decreasing returns to scale, using the product funnel, I can see that till what point of time or what point of amount it makes sense for me as a company to keep spending money on this plan? Till what point is it financially feasible for me to get customers this way? Okay.
What is the optimal marketing spend we can have at this product?
Got it. I think we have covered most of the metrics, but one key thing that I think remains is talking about retention. Another one of the key areas that you work in. So we have talked about lifetime value, CAC, product funnel, repeat purchases, but one is retention. That is, once we have acquired a customer, we retain it in our platform. It does not shift to a competitor platform or does not give up on BNPL altogether. Both of these are equally harmful to us. So can you talk about retention? What are some of the key things that you look at? Is there a specific metric you look at? How do you decide what kind of incentives to give to a customer to retain him? If there's a churn in the portfolio, that is a customer leaving, new customers joining, how do you look at it broadly? Yeah.
So there are a lot of ways in which you can retain a customer, right? Like, for example, the most obvious answer that everyone gives is to give them offers.
Yeah.
Give them offer. But what we have seen in lending is that, again, by BNPL lending is that the primary incentive of a customer to come to your platform is not the offers. That only happens when you are shopping. Again, we are not yet a shopping brand. We are again a BNPL
payment option. Yeah.
It's a payment option, right? So it's a convenience. What are the different options I'm getting? What is the wider selection I'm getting? And how much am I getting from the how much can I pay using that platform from that BNPL player, from the payment option? And that is again a function of the amount, the credit limit that the platform is giving you.
Got
right? It. So retention is basically, I'll talk about the experience part later. But again, we have to understand exactly why the customer is coming to you. A customer, not all customers are coming to you because of offers. And if I go to Swiggy, because I'm going to Swiggy 2 times or 3 times a day, example, then I might be looking for the offer. But again, for a business, for a business in which we call it infrequent business, basically infrequent business, in which a customer comes to you when they need you. Then it's not just about the offer. Then they would have come every day to you, right? So it's one thing is the experience. Okay, I'll just take a step back. The first thing in any financial product is the trust. You cannot let go of if a customer at any point in their time thinks that I cannot trust this medium platform, they will never come back to you. It's not the convenience, also it's not the experience, it's the trust. Our money going away from my account is much more like we all know, right? The loss of 5,000 rupees. So basically what I was saying is that the main reason a customer comes to your platform, for any financial product, with any financial product, the ticket size is, let's say we are talking about a customer whose average income is 40,000 or 50,000. They're purchasing something of 10,000 rupees. That is around 20% of their income, right? And again, 20% of anyone's income is something that they care about, right? It's not 100 rupees per transaction or 50 rupees per transaction. So that trust is the most important factor. So how we think is that, and again, it's not just ZestMoney. Everyone, like a lot of this consumer brand thing is that there are levels where you can screw up as a company. Right? And that happens for everyone, even Amazon fails, even Google fails, right? Sometimes. But when you screw up, you have to, when there should be a threshold, like the customer has trusted you enough before you screw, because it will happen that sometimes something happens that something breaks, right? It happens. But the first experience can never be that. And again, for a financial institution, it cannot be like there's a number before which you can never screw up, so that the customer will never come back to you. Right? Even if I made 10 transactions in ZestMoney or any other player, basically, and again, if something happened, then again, for example, that like I have paid something, example, and again that did not go to the merchant, and then again the money is deducted from my account from my limit, and I have to pay an interest on it, then my CIBIL breaks down, something like that. That will be, they will not trust me again, and that is one of the most important. And that's a very product specific, tech specific thing, right? So that's the first part. The second part is basically the experience. If we have been promoting ZestMoney, like any BNPL player, as a very convenient thing. It's a really seamless experience. So the experience has to be 100%. It has to be top notch. It has to be a one-tap solution, right?
Got it.
The third part is basically the transparency part. Credit cards are like infamous for the transparency, not are being non-transparent, right? And that is why like this BNPL players are being positioned like we are very transparent, and suddenly you see that the EMI plus the principal is not adding up to this what you have promised. then people lose trust. So these are the three major things that are like the core business. And then how to retain customers is basically, again, if I talk about the technical, like the business specific things now for ZestMoney, is basically having, so the customer knows that I can go and pay whatever I want, whatever I transact using ZestMoney. There's a wider selection. Talking with merchants, like having more number of merchants across more number of categories, right? Giving the best options, like for example, a 6 month 0%. And again, that is by talking to the merchant, by subventing the merchant, subventing the entire 6 month 0% for me. Or going into a discount sharing model with me. Like for example, that happens with a lot of brands, so that the customers don't have to pay and we are sharing it, right?
Got it.
So all this helps retention. But again, for me, the prime driver is basically how to gain trust and not lose the trust for the customer, and how to make the experience the best thing for the customer.
Got it. Makes sense. I think that's a very good point that you have raised, that even if I consider my own personal experiences, building trust in a financial product is the most important thing, because I'm willing to experiment with anything else. Like I'm willing to experiment with a new e-commerce website or a new D2C brand. I don't mind spending 200, 300 rupees there, but I'll be very cautious while like what option I'm selecting while spending those 300 rupees on that website. Like if it's a trusted name that I see on the screen, I'll be like, yeah, even if this brand does not work out, I know that my finance details will be safe. Or the other way I'll adopt a financial product is if a lot of people that I trust are using that product, then I might gain that trust that I can try it out as well, because a lot of people I look up to or I am find trustworthy enough. If they recommend me, I'll use that product.
Exactly, 100%. Yeah,
that makes complete sense. All right, I think we have talked a lot about BNPL and Matrix and everything. And before we wrap it up, I just want a question about your journey so far in this field. So you started out working as a VC at Samsung Ventures, not a traditional VC, but VC in its own way. Yeah, making more strategic investments, as you said. And now you have pivoted to a strategy role in a fintech startup. So how was your experience working at Samsung Ventures and then moving on to ZestMoney, both from the kind of quality of work, kind of work that you give, and what were the kind of responsibilities upon you, and how different are the worlds? Like as a strategic VC, you are behind the lens, you are behind the front end. You are looking at strategy, but you're not really driving that strategy. But as a strategy guy in a leading fintech startup, you are actually on the ground, seeing change, seeing whatever you implement happen every day. If you can draw some parallels, how has that journey been? How has that transformation been?
Yeah. So before MBA, I was working as a consultant, and again, that is the same as, like for example, you are having a bird's view basically, and you are like looking at the business but not involved in the business completely. You're not taking operational part. The same happened in Samsung. Like we were looking and evaluating a lot of startups, talking with them, understanding their business. But again, you are not actively involved in the operation of the business, right? But you are understanding the business and you can look at a lot of business models, look at a lot of different industries. You can draw parallels to them with them, and you have understanding of the entire macro. Like what might happen, which can work out, which cannot work out, it might not work out. Basically, you have that idea. But again, what you don't have is how a company is working. You don't have an understanding, like you don't have a great understanding of how to make a company go from 0 to 1 to 1 to 10, right? For you, it's not that different from making. But again, when I joined ZestMoney, like I joined like quite early actually. Like we were 2019. We were like the number that I know that and the number that we're doing now is very different. It's way more, right? So basically, I have seen a company go from 0 to, like, if I consider that as 0 to 1, and now we are going from 1 to 10. Now I understand what are the different challenges in this and how different it is. 0 to 1 is basically fixing leakages, simple. And again, having a PMF, product market fit. Now, when you have a product market fit, a lot of other competitors will also come to the picture. That is again the natural way, right? Then from 1 to 10 is basically what we are doing at this moment. It's basically a very different way of thinking in which you are scaling up. And for that, the thought process is very different. To be very honest, you cannot really, from a startup, you have to go to a process. You have to think like how an Amazon or a Samsung works.
Got it.
What defines them? It's not obviously it's the people, but again, that Amazon is an amazing company, is one of the best companies because of the process. Even if the top management lives today, the process is so good that again a lot of things will be there, right? So basically, it's like defining how the process. Yeah.
Got it. So you are saying that 0 to 1 is more about survival, and Just making it to that one stage wherein if you are surviving and growing, that means that you have established product market fit and you are still there, which is an indication that there's actually need for this product that you're offering. And 1 to 10 is more of building an institution. Yeah, as you said, building a process is institutionalizing all those things that will enable this company to grow as a separate entity, not just driven by founders or not just driven by certain people, but as an institution that can grow, survive, multiply on its own with a certain set of processes, guidelines, strategies, toolkits, everything in action. So it's more of a building process.
Exactly. It's completely that basically. And again, you have a lot of pushbacks again because
obviously
people don't think like that when they're in a startup. They think of an ad hoc thing. But again, to be the person who is saying that we cannot have ad hoc things is something that I am doing at this moment actually. Like I am trying to build this entire arm of like the customer basically, the customer process basically. A lot of this processes.
Essentially has to be a mindset shift. So essentially you are progressing from a startup culture to something that is going to be there for a very long period of time. And you're trying to build in processes and checks and balances and everything so that it's more institutionalized and not reliant on few people or few certain choke points, I think.
Exactly.
Yeah.
Exactly. Yeah.
Makes sense. It's been great talking to you, Aritra. I personally got to learn a lot. A lot of my doubts got cleared because not a lot of literature is available out there on understanding these metrics. This is something that I think you learn from practitioners only who share their insights and how to interpret them with you. So I think this would be a great conversation for listeners to listen to and learn from. I hope you enjoyed talking to me as well.
Yeah, man, I really enjoy talking to you. And again, I understand that. Right? So basically, when you are in a business, it's much more, you understand a lot of these nuances, right? And that is the reason that I wanted to shift to an operational from a VC or from a consulting. And that is the reason. Like, you understand this thing much more when you are inside the business. That's a different kind of thing that you might enjoy, which I am enjoying a lot. And again, so yeah. But yeah, really like that.
Yeah, all the best for the future, Aritra, and hope to see you on the show again, maybe sometime down the line. Thanks for taking out time on a weekend. Thanks a lot. Thank you.
Thanks a lot, man.